Walk me through the push-pull here. On the one hand, the IEA did not seem very confident about global oil demand really recovering. On the flip side, you have China still buying a lot. How do you look at it short-term versus that medium-term outlook?
Well, Alex, I think it's. Thank you for having me. I think it's pretty clear that the Chinese economy is in a lot better position than most other economies around the world. They've done a very good job of controlling the public health problem across the country. They've also stimulated heavily, and people are back to work. They're back on public transport. They're flying around the country. So that's where demand growth is occurring. Plus, of course, people are still favoring private transportation over public in China. So there's a lot more demand for cars and gasoline. So that's all helping. In the rest of the world, we're still looking at a pretty somber outlook with European cases in the last few hours surpassing U.S. coronavirus daily cases. Now, Europe, I think, is over 50,000, and the U.S. is just a little under on the 7-day average. So we don't seem to have the pandemic under control, and that remains a drag. People remain working from home in the U.S. and Europe, and some cities are being locked down. So that's been the drag, really, Alex. That's been the story. And I think a lot of us are getting a little anxious about how long this is going to go on for, hoping that it ends in the next quarter with all the vaccines in development. But obviously there's no clear timeline on when people will be back in the office and back on a normal business travel schedule.
Francisco, therefore, how easy is it to forecast, let's say, the first 6 months of next year? We don't know what's going to happen with the vaccines. We were talking to J&J CFO a little bit earlier on. Maybe the timeline gets pushed out. We also don't know how easy it's going to be to distribute this vaccine and how easy it is going to be to get it into people's arms. We don't know the result of the US election. We don't know a whole bunch of things right now. What does kind of January to August look like next year in terms of your ability to predict oil demand?
Well, so one thing we know for sure is that oil needs middle distillates to lead the market in the winter. The summer is much more of a gasoline story because in the summer we use a different kind of gasoline than the one we use in the winter, which is a lot easier to make. And therefore, what we are seeing right now is the diesel complex, the jet fuel complex is still very heavy. There's not much demand, and most of it is driven by the 50% plus collapse in aviation demand in air traffic. So what we are facing here is a middle distillate complex in oil that's still very depressed. So to what extent that changes in the next few months, I think is gonna push us either a little higher or a little higher. And then, but I think once we get to next summer, to your point earlier, look, there's 320 vaccines in development, the way I understand it. Many of them are going to phase 3 trials. By the first quarter, we should have a few good candidates. And then hopefully by the second quarter, we have those in people's arms, to your point earlier, which means that maybe next summer we can see a much better oil demand outlook with both gasoline doing well, summer gasoline doing well, but also the middle distillate complex and jet fuel recovering. So we are more constructive into our summer window, assuming that science moves along the scheduled times. But we are depending, of course, on that.
A lot of things that we talk about here related to the market are a blue wave in the U.S. That might lead to reflation, steeper yield curve, et cetera. If we do get a reflation scenario globally, do commodities still present a good hedge against that and a way to play it? And if so, what commodity then?
So so there's 3 things that you need to look at a bit separately here. There's oil, there's copper, and there's gold. And I think when you look at the next few months, it's clear that oil has a lot of spare capacity and very high inventories to deal with. And of course, a lot of uncertainty around the demand recovery path because COVID is first and foremost a crisis of mobility, not an industrial crisis or a banking crisis, right? So oil is perhaps the weakest of hedges, although I think eventually will recover. Copper, on the other hand, is probably the better hedge. So we've been telling our clients to use copper as a hedge against inflation, because also copper links directly to the energy transition and to the green economy that presidential nominee Biden is pushing for. But also, I think copper will do well under the Trump administration because you will have potentially big infrastructure stimulus. The worst scenario for commodities, and I think also probably for markets, is essentially a split election, and even more so than that, a contested election followed by the split election, right? So if we get that, I think that's going to be pretty terrible for markets because I think even in that case, I think probably even gold doesn't really do well. So we are concerned about that outcome, contested plus split election, or just outright split, because we think that would be a situation where fiscal stimulus doesn't come through, where there's potentially downside to the economic cycle, and that's the one scenario I think is harder to hedge. But inflation, in terms of a hedge, we think copper is probably the better one, followed by gold. If you believe fiscal stimulus is going to be coming in spades here.